I'm Patrick South. I'm with the Chamber of Digital Commerce. The Chamber is a nonprofit, policy-focused organization that touches on key issues around taxation, considerations around the treatment of tokens, security versus non-security tokens, oversight of the spot markets, custody issues, AML issues.
Thank you. Yeah.
Etc. Anyway, I'm really excited to be here for this panel today. We've got some fascinating panelists along with us. I'll let you guys each introduce yourselves, a bit about your firm, and then we'll dive into the agenda.
That's good.
Mike, we'll start with you.
We'll start. So my name is Shaulov. I'm the CEO and co-founder of Fireblocks. Spent the last 20 years in cybersecurity and started Fireblocks about a year and a half ago. Basically what we focus on is providing a secure digital infrastructure for the active part of the market. We're basically handling both like the storage and movement of the assets between counterparties. Some of the biggest OTCs and market makers are sort of well known for being our clients, like Galaxy, Genesis, GSR, and others. So really excited to be here to talk about a little bit about how we sort of like changing the infrastructure for capital markets.
My name is Hehmeyer, and I come from the futures and options trading community in Chicago. So I started in the futures business 40-something years ago. And I like to tell the story that I've been really sort of astounded. I use the word gobsmacked, which my wife doesn't really like, but I think it works as an old word that is sort of coming back, and it means sort of astonished. And when I walked onto the trading floor in 1977, I was just amazed at the energy and what was happening in this trading floor environment. And then in the 90s, we all stood around and clicked on the button and we traded with somebody who was on the other side of the world. It was the first time that I'd made an electronic trade. And then about 2 years ago in the office, one of my colleagues and I sent from my mobile device to his mobile device a Bitcoin, and it was like, oh my gosh, that is like something I've never seen before. And so Hehmeyer Trading, which is a traditional member firm of the futures exchanges, the CME exchanges and others, has recently really developed its market-making business, making markets in various crypto assets, mostly Bitcoin these days. We have a cryptocurrency index and an index fund that's a registered commodity pool under our registered entity that is registered with the NFA, and our commodity pool, which tracks the index. The index rebalances once a month, and today it's about 78% Bitcoin. It's cap weighted, and we learned a lot from developing the index, custodying the coins in various places, and this evolution of the custodial capabilities and security, in my humble opinion of watching this stuff develop, is the next big wave, and is going to facilitate in sort of a massive way the ability for mainstream institutions to enter into this digital market. One last tidbit was when I was talking to a guy about investing in our fund, and he said, Chris, I'll put some money in your fund and I don't mind losing some money. I just don't want you to lose the money. And I said, that's me neither. And so this custodial stuff is really going to facilitate just that fear.
Hi, I'm Diogo. I'm the person trying not to lose the money.
Diogo, are you just sitting on stage all day today and
Yes.
transitioning through every topic?
Same chair all day.
We'll get to hear your views on taxation later.
Yes.
Wonderful. Chris, you touched on this a little bit, but your career's been really impressive.
Thank you, but long more than everything else, but yes, long.
For 35, you've made the most of it. So looking at some of the oscillations you've seen around market infrastructure development, what did you and Hehmeyer see in this space that other market makers and in folks in traditional finance may not have seen as early as you had that interested you most?
Well, we weren't one of the early adopters of Bitcoin and such, like a lot of people were that got in real early and bought Bitcoin really cheap. Having said that, the ability to transact on a peer-to-peer basis is something that's different, of course, as we all know, and to be able to have those assets secured either by a multi-party computational way or actually in a custodian, and have the parties transact and then facilitate the exchange of the assets is something that holds, of course, I think we all agree, the potential of dramatically taking expenses, costs, and frictions and inefficiencies out of the financial system. And I've seen a lot of inefficiencies in the financial system when I used to scream at guys across the room, right? With 500 guys in a trading pit. It was mostly guys, a few women. And that's all, this technology changes that in sort of an astounding way. And so I pointed out to any of you all that are here from out of town, just outside, there's a stained glass window that was done by Chagall. It's very famous. And I recommend it to all of you from Chicago or from out of town. The Chagall windows are beautiful and fantastic. And in Chicago, there's a lot of public art. There was a big effort, which is described on the wall out there. In 1967, I think, is when the Picasso was unveiled. And when they unveiled it, there was a gasp. It was, because nobody knew what is this thing. And as the quote out there of Mayor Daley says, what is strange to us today will be familiar in the future. And of course, today, the Picasso is a sort of a symbol of Chicago. And that's the way I view these capabilities, particularly the infrastructure. I got moved from the raising assets panel to this panel, and I don't know if that was a good thing or not, but I was flattered to be able to join these guys. But this infrastructure is going to bring to institutions, it took a long time in the futures markets for the Goldman Sachs and the big banks and all the primary dealers to come to the futures, to trading futures. They were all skeptical. They didn't like it. It tightened the markets. But it just took a little while of a few of them getting in there and making some money, and then all of a sudden they all came in there once they trusted the futures infrastructure of a clearinghouse and such. But that took time. They didn't trust it. They didn't like it. And I think in watching through the years, and I guess I'm one that has a little bit more perspective just because I've been around it, what these guys are going to be offering is the chance for the CFO for fill in the blank, Target, United Airlines, whatever consumer company it is that will take in a digital asset that they can feel very safe about putting those assets someplace, getting them transitioned into another asset through a market maker where they need a price. And do that safely. And so that's going to facilitate, I really believe, the ability for mainstream businesses and consumers to be able to, it's going to be disruptive, but to move away from these traditional rails that have a lot of expenses and inefficiencies into something that's much more efficient.
Thank you. For the panel here, we've seen a ton of maturation in the market infrastructure space over the last 12 to 18 months. It's been exciting to watch, specific to digital assets. Emergence of prime brokerages, Tagomi, FalconX. We're seeing a ton in Asia. Custody providers, VC-backed ones like Anchorage and Fireblocks here, against some legacy brands that are in the space. You're looking at Fidelity Digital Assets and folks like BNY. On the future side, we're seeing Bakkt and ErisX and others. To me, that's very energizing, right? Positive momentum for the space. What I'm really curious to get your opinion on is, in my mind, we really appear to be mirroring traditional financial infrastructure in this space. So despite what a lot of people are arguing that we're disrupting, it seems like we're recreating all of this all over again. Is that the intention in your minds right now, that we are going to be recreating the existing financial infrastructure, or do you see true disruption that some of these entities are looking to provide?
So I guess I'll take the first shot at that. I think that the answer is yes and no. I think that right now there are sort of deficiencies in the blockchain, in the crypto market compared to the traditional market, just like in terms of capital allocation. Because to be honest, with all due respect to Tagomi and FalconX and some of the others, they are not really like true prime brokers. It's not like that Hehmeyer can basically contract with them and they can accommodate your capital requirements. Potentially, they do have a niche market of smaller funds and high net worth individuals. Now, the reason for actually not having a prime broker in this space is because some of the I would say, infrastructural elements were not solved to actually accommodate the security requirements of the exchanges. And the reason for that is that at the end of the day, if you want to basically create sort of one pile, or basically if someone that actually has like, a lot of assets and he wants to allocate those assets and be able to trade those assets across multiple exchanges, right now it's actually impossible, right? Because at the end of the day, if you try to put it in sort of like a cold storage custodian, the exchanges usually they have different preferences of who they're willing to work with and who they're not willing to work with, and you will end up with this huge fragmentation that at the end of the day you will only be able to work against a very small subset of exchanges that will accept the counterparty risk to that cold storage custodian. On the flip side, basically what some of the, for example, Tagomi and some of those other guys are doing is basically they allocating their own capital across multiple exchanges. They sort of will accept your credit, basically take your credit in a cold storage custodian that they selected, but that's sort of also sort of creating a cap, right, in terms of the assets that those guys have, and they also venture backed, and basically the amount of funds that they can allocate is small. So the question is, how do you sort of bring the exchanges to the point where you can sort of present them one pool of capital, and they are actually pretty comfortable that they both have sort of a cryptographic lock, right? They basically have some level of possession of the asset. If there is a cyber threat or technology risk, they eventually can get the margin that is allocated over there. And the second question is what will happen if basically the client will default and how this will be distributed, right? And I think at this point in time, we are actually not in the stage that we are actually Fireblocks. We are working on getting a solution out there, which is an infrastructure solution to solve that problem. But the current models are just creating more fragmentation, and they are they're actually less efficient than the traditional capital markets, because if we actually thinking about just putting our assets in multiple custodians and hoping that the exchanges will accommodate that probably would better just settle on DTCC in 4 p.m. every day, and that will be more efficient. And as Chris said, that's probably not the most efficient way to do things.
I would jump in and say, from the other side, there's certain things that are going to be the same. There's certain things that are going to be different. That much is clear. I do think on the differentiation side, where the asset class is very different. Holding private keys is completely different than what any kind of institution has been doing for a long time. And really the only institutional foray into this is Fidelity, and that has taken 3 years, and the product is still not out yet. So if you see, nothing to their credit, they're doing it. But the risk appetite and the capabilities that you need to actually build something like this are just something that normal institutions do not have on hand, can't recruit for, can't hire for. Just that talent does not get attracted to opportunities like this usually. And then on the other side is it a Bitcoin maximalist world, or is a world in which these private keys are just constantly moving? That also completely changes the mechanic. You can't wrap an asset. You can't do physically settle futures contracts if the asset is not staking and losing 20% while it's actually under the warehouse. There are things like that you just can't do. And so, because the client doesn't want to trade with you, because the moment they put the assets on you, they're going to be losing 20% of the value. And so, of course, they're not going to go with you, which means that then they'll opt for other alternatives, and those alternatives are alternatives that are effectively crypto native. So it really depends on how crypto turns out and how fast it turns out to be this way. You're seeing a migration from proof of work to proof of stake. You're seeing a migration from distributed, decentralized governance based on humans to attempts at governance on the assets themselves. And that's just going to change completely how these things work, because it requires technical integration of the assets themselves. And then the other thing that I would say that is different is we have this settlement layer. Every single asset has a settlement layer and is a final asset, and it has finality. Some of them in seconds, sure. Some of them in hours, and with basically a stochastic method, which confuses everybody on Bitcoin, and it's kind of weird. But we are solving those problems. And so the reality is that there won't really be a DTCC for sure, and everybody's trying to be greedy in building their own settlement layers. But when you build a settlement layer and you're competing against the asset's own settlement layer, which ultimately is what actually you derive ownership of the asset from, it is not clear to me that like abstraction in this case will actually work or will work for a majority of the market. And specifically like for some assets that have deep finality in seconds, why would you use anything else? It doesn't make any sense for you to not use. Why take counterparty risk? Why not actually like have keys that are for the final owners? And it's cheap to make sure that you have no omnibuses and you actually have keys owned by specific entities. So those would be the two things. The fact that the assets are very different, need active participation is gonna basically make sure the market doesn't look like the traditional one, and the fact that we have really good competing finality and settlement networks might actually mean that there's no emergence of one settlement network.
Yeah, and so just to make sure I'm understanding your latter point, so in today's environment, you have a kind of traditional settlement and clearing that's DVP, PVP, the traditional CLS, and you're pointing to an existing gap that's in this space of how does that get filled over time, given some of the transition that we're walking through.
So I think, at the end of the day, I still think that the DVP and PVP need to exist in this space, because otherwise you have a counterparty risk, but the question is how it's going to be solved.
That's right.
And to use sort of like, some intermediary is probably not the right solution, because smart contracts or atomic swaps were created exactly to solve like, the PVP, DVP problem. The thing is right now that, by the way, like in most of the trades, most of the like OTC or broker-dealer trades, you have like one side that is digital and one side that is fiat. So you do need some construct that is like partially. So the atomic swap type of technology doesn't really work, because how can you instruct like Signature or Silvergate to do an atomic swap? But I think that like now that we're actually seeing a much more like a much bigger adoption of stable coins, right? So USDC and PAX and all those like stable coins that are coming in, that I think like they have a fairly good governance, and people are actually like willing to count them. I think that actually like atomic swap and that kind of technology will become quite important in terms of like mitigating counterparty risk and sort of eliminating the question of like who goes first, who goes second, and sort of exposing the parties for default.
I want to pivot us slightly and go down the custody path, given some of the insight that you both are going to be able to provide here, a little deeper in the custody path. So, Diogo, last night, got back to my hotel room. I was watching just Bitcoin plummet and scrolling through Twitter, and I started chuckling at a tweet of yours. It says, security can't be measured in Fahrenheit. If someone sells you cold storage, it means they don't have the competence to build something better. No more pirate custody. Great tweet. I'd love to hear you.
I appreciate that. It was a moment of inspiration right after a panel with Mike Belshie from BitGo. So that was the inspiration.
I got +1 for that.
To unpack that a little bit, like, can you elaborate a bit on your specific thoughts there? And then two, can you talk about the different needs of entities in the space today? So how an OTC or prop desk may be approaching custody vice a VC?
Yeah, absolutely. I mean, we talked about this I talked about this just a few minutes ago, but what I would say is that there's two ways of looking at this. Our clients want speed, period. And above speed, they want safety. No compromise on safety, and they want speed. However, there are several ways of doing speed. And exactly how we were talking about settlement networks, one of the ways to do speed is, can you settle on chain, and can you actually move assets on chain as fast as possible? Or can you abstract these things, put them in vaults, and then basically have databases and kind of like just change the ownership on a database, and then do settlement at some later date. The argument for Anchorage is that we want to support the crypto native abilities of the asset itself. And since we've created a system that allows us to have better safety in the cold storage, then the time no longer matters as much. And we don't need to wait 48 hours to ensure security. In fact, we don't, in very soon, we'll need to in 8 hours, and it will be just minutes. And if you have minutes, the ability of having better safety in the cold storage, to have minutes for reconciling these on-chain and actually sending out these transactions, then the clients that come to us are very happy because they can participate with, they can send to OTC, they can spread it around on the exchanges, they can do safe custody of their assets in a way that is a lot more efficient, instead of having part of the capital and having, like a bunch of capital distributed through the exchanges that they can't actually make use of. So they have it in safety instead of exposing themselves. So it's two fundamentally different ways of looking at it. And effectively what I saw when we were creating Anchorage was everybody was assuming they can't do the latter. So they can't actually do and get to fast on-chain transactions with safety that is better than shoving things in a vault. And basically Anchorage is proving them wrong. So the tweet really comes from that. If you're saying that somehow your security is hot and cold and you're measuring security in Fahrenheit or Celsius for those of you from Europe, if you're measuring security in a temperature, it only means that you don't have competence to build something better.
So if I may add to
Please.
that, yeah, I think this, so I guess we have a slightly different client base. We are mostly, so I think there are VCs and funds that are sort of looking for a fully custodial solution. In our case, we are actually sort of serving the most extreme part of the market that needs actually a sub-second access to the asset, right? Like when we have people that are in ARB trading, people that are selling, that are doing high volume OTC transactions that actually when the market is falling, like what happened 2 days ago, they don't have even 2 minutes to wait before they move the asset to an exchange. So in our case, we actually sort of create, I think what we've done, and clearly there are different security models around how to do really, really fast access to the assets. I think what Anchorage is doing is sort of one type of approach. What Fireblocks is doing is a slightly different type of approach. But it's clear that in order for the market to function, we need to get to seconds, maybe minutes type of settlement time and access time in order for really sort of unlock, especially with a volatile market like this. Now, I think that fundamentally, and that's sort of an interesting observation. I think that different customers are comfortable with slightly different models with custody. So for example, what Anchorage and some of the others are doing is sort of full custody, right? Basically in terms of the key material, 100% of the key material is sitting with them. And I think that generally speaking, there is a really interesting group of sort of managers or funds that this is sort of their requirements. They don't really want to touch any key material. Whereas sort of our customers that are, to be honest, they spread currently globally from, let's say block fields here in Chicago to folks in New York, London. We have customers in Zurich, Hong Kong, and Moscow. And they actually much more comfortable with something that has a flavor of self-custody. So basically, we as Fireblocks, we never hold a sufficient key material to actually instruct the movement of the asset, because we are using MPC, which is sort of a next generation flavor of multisig. And that solves actually some of the, I would say, jurisdiction issues. Why? Because, for example, if you have a customer here in Hong Kong and you are, as a service provider for security, incorporated in the United States, clearly, the first fear is unrelated to security. It's actually a jurisdiction issue that they would say, well, if one day the Chinese government or the Hong Kong jurisdiction will be happy with a crypto asset class, but the United States will actually decide to crack down on that asset class. If I'm having 100% of my key material in the United States, that's it. The assets are gone. And if you are able to sort of split sort of and I think that's the nice thing about crypto is that essentially you can sort of, you don't really need to go full custody, because full self-custody, sorry. Because with full self-custody, the client has 100% of exposure. If you're actually bringing it to something that is a mutual responsibility in terms of the cryptographic lock on the asset class, then you can actually solve some of those issues.
And what I would add, just a quick note, is that Anchorage definitely is on the side of, we are a qualified custodian, we are fully in the United States under the regime of the United States, we have insurance, we have all of the checklists, so it's very much of the other side of the market. We're more conservative, people trust us with, large sums of crypto. And so that means two things. Number one, we have registered investor advisors on the platform. Being a qualified custodian actually means that we must have possession and control. So exclusive control and possession of the key. That actually means that us as Anchorage, we have to have access to all the key material, and the client cannot have access to the key material, and we cannot have the client have a way of blocking us from transferring their funds if the government does come in. And so that's the burden and the great thing about being a qualified custodian, and that's very much what we do. Qualified custodian, totally regulated, we have full access to keys.
With sub-accounts?
Yes, so it's all segregated. All the clients are segregated. They don't see each other on chain. It's completely segregated. And we obviously are very heavily regulated and we follow all those regulations, but we are full custodial. So the keys are generated, safe kept, and the business continuity is all up to Anchorage. That is what you're paying Anchorage to do, is this safekeeping, the business continuity, ensuring that the keys are safe, continuously track blockchains, track forks, track airdrops, what is happening in the market, are these nodes up, are these nodes down, and then safely receive instructions from clients. Are you being coerced? Does somebody have a gun to your head and is forcing you to move $100 million of Bitcoin out? We have systems for that. Quorum, there's no single individual, both on the client side and on Anchorage's side, that has the ability of moving funds. And so it really allows you to basically create an infrastructure. The same way that you run your company, you could have a structure of a quorum system that has people vote, and only when those people vote, actually the assets move. So it's about that's the level of safety.
I want to pull us out of custody really quick, just given some time that we have left. Chris, I want to hit you with one idea, and then I want to do a quick lightning round, and then we'll go to the audience for some questions. So, Chris, given your futures background, last week we saw the announcement that Coinbase's former VP, Dorothy DeWitt, went to CFTC to serve as Director of Market Oversight. Arguably an exciting sign for the space. Meyer was a good proponent, and it's neat to see that continued. What are you looking forward? What are you most excited about in the future space as we look to digital assets and the role that they may play there?
Well, I may have one of the questions, by the way, because a couple of days ago we had assets all over the place. We're at 20 different exchanges. I got assets moving all over the place. I'm going to get out. In trying to talk about this technology, I get out on thin ice pretty quickly. I need my colleague Morgan to help me with this. So, because that's a challenge, right? We have millions of dollars accumulating in one place, being depleted someplace else. The market's breaking, counterparties are calling up, and so then you got to make sure they're, there's counterparty risk in that kind of movement, right? Because somebody could not know in the futures parlance, market parlance, DK means don't know. Somebody could say, I don't know that trade, and then you've sold it to them at a much higher price with that kind of volatility. It puts a lot of stress on the risk management of all that for somebody like us. So I do have a question, but the question you want me to answer though,
on the future side of the house?
On the future side of the house. So the backed thing with physically delivered futures, I believe pretty strongly in listening to the backed people and talking to the CFTC that this physically delivered future, and there are a couple of others coming to the marketplace. I think we've all seen at Eris and such, and there's some very good ones. It's the ability to use the traditional rails to try to accommodate the commercial activity that I think I was talking about, right? So if you've got a Starbucks and they're collecting a digital asset, it could then go into backed. They could sell a future, deliver the future through the ICE Futures US in a heavily regulated market that's very dependable, that the CFO can go in and say to the board of directors, we're going to collect these digital assets, we want to deploy it in our stores, the digital assets are going to go to backed, we're going to sell a future against it that's priced in dollars, we're going to receive the dollars in our FCM account, and then we can withdraw the dollars and go make payroll. So I think it is a real attempt to use traditional rails to facilitate this need to accommodate for larger companies, the consumer's real interest in using digital assets. And I say it's an interest, it's a growing interest. People are starting to become familiar and capable of using them. So the futures market, the challenge is for the regulators daunting. And having been very involved in all kinds of committee work when the exchanges were mutually owned and such, just to give myself a little legitimacy on this, I was chairman of the board of the National Futures Association, which is the self-regulatory organization in the futures market. And NFA has been very good, and for the most part, CFTC has been pretty good about approving these contracts and taking some risk, because they've gotten a lot of heat, particularly, frankly, from the banks that have said, oh my God, what are you doing? And those two organizations, CFTC and NFA, have been fairly progressive in coming along and approving these products. But we were talking a little bit in the hallway, is this asset, and from a tax perspective, intangible or tangible, right? And so is it a security or not? I'm of the opinion that the SEC would love for Bitcoin to be a security. They would certainly want Libra to be a security, because it's got some sort of payment to it, so it's an organization, so it's arguably security. I think that FCC, if they took that position today, they'd get a lot of pushback. But the point of that is that the new chairman of the CFTC has been very quiet, and he's trying to gather a lot of information. But I've had the chance to talk to him about it. He totally gets it. He understands that this is a real challenge for the marketplace, for the participants, for the businesses that are emerging in all of this, and he gets it. And he came out of Treasury right under Mnuchin. And so at the most senior levels of our government, they're talking in the United States, they're talking about it because they know that this is evolving. But it is a daunting proposition how to try to write some of these laws.
We've got the president tweeting about it. That's as good as it gets.
He's tweeting about a lot of things.
And this is, tell me if I'm wrong, this is really security as a service, right?
That's the way that we view our it's security and operational platform as a service, right, at the end of the day. Actually, we took sort of on a sort of a regulatory position, right? We actually took almost sort of the other side of the map, where we actually went to the New York DFS. We presented them the technology, and actually they gave at the end of the day, we have a memo which basically says that that bit licensees, they can use our technology, and it actually doesn't infringe their license, right? So we only deal with institutional clients, right? So we really making sure that they have the proper licenses, and they have GC, and they know what they're doing, right? We will not going to face consumers at any stage. But that also allows us to basically, particularly for what we do, and you probably, Chris, know better than me, right? At the end of the day, this is a global market. And because we are not only creating the storage and the custody, we're actually creating secure rails that you can move the asset between the counterparties. You have counterparties in Switzerland, you have counterparties in Hong Kong, you have counterparties in Japan. And therefore, and speaking about insurance, so basically we also have insurance both for storage and motion. And actually our security, our insurance in motion, if both counterparties are actually using our software, we are insuring the transaction end to end, right? Basically, if it doesn't get to your counterparty, there is sort of a potential claim. So for that particular reasons, we do need to make sure that we are able to sort of seamlessly operate across jurisdictions. And we are in we discussed with FINMA, we discussed with the German regulators. So at the end of the day, we are trying to bring ourselves into the position that we are a security and operational service provider, and that's sort of what we're trying to accomplish.
We've got about 7 minutes left. Any questions from the audience?
Yeah, can you talk a little bit more about the MPC technology? You discussed that very briefly, but you did say it's the way of the future.
Yeah, it's a flashback from yesterday, right?
Yes.
Yeah. So I'll give my, I guess properly explaining MPC requires a PhD degree in cryptography and probably 5 hours. But in a nutshell, you can think about it as sort of the next generation of multisig. So how many of you are familiar with multi-signature? Okay, fair amount, right? So with traditional multisig on Bitcoin, you're basically creating a wallet, which is, let's say, 2 out of 3. Everything is on-chain, it's visible on-chain. With MPC, you're basically able to accomplish the same thing on the cryptographic layer, which is basically the elliptic curve algorithm for most of the chains. And the fact that you are basically able to do it in that level, which is sort of on-chain, you're able to do, you're basically both generating the key in a distributed way, and you're also signing a transaction in a distributed way. So let's assume you have 5 out of 6 participants. No one at any single point of time, not in the creation of the key and not in the signature time, basically has the full key material. That's sort of guaranteed, and therefore you're sort of eliminating a single point of compromise. In addition, you can ask yourself, okay, so what are the advantages of using MPC again to multisig? The actual thing is operational, is basically operation. So with multisig, you're locked into a single address, and you're also locked into a single construct, which means that if at day 1 we created 2 out of 3, right? And then we hired another employee, and we now need to move to 3 out of 4. We need to create a new wallet, and we need to basically move all the assets from the old wallet to the new wallet, and we need to inform all of our counterparties that the address changed. With MPC, you can do it seamlessly, sort of like on the cryptographic level. You can basically add participants, remove participants, rekey the wallet. But from a blockchain standpoint, it removes the same, and therefore it actually eliminates all the operational burden of using multisig. So for organizations that are, like multisig is great, don't get me wrong, but, and to be honest, it's actually not, it's great until the point that it's actually not supported by certain protocols like Ethereum. But the beauty of MPC that it's cross protocols. It works the same way on any blockchain protocol, assuming that they use standard encryption, and it really sort of supports scaling your organization from an operational standpoint.
I'll add the asterisk onto this. Explanation is great for not having a whiteboard. That was pretty good. The asterisk in the future version of MPC. MPC is awesome, it's cool technology, it's very useful. It might not be useful in the future. And the reason why it might not be useful in the future is the reason why we got MPC in the first place is because we can't do anything with this construct of Bitcoin and that Ethereum uses, which is a CDSA. So a CDSA specifically does not have the ability of doing threshold signing. All of these new assets are coming out, including Bitcoin, is adding Schnorr signatures. Once you have Schnorr signatures, or once all of these new assets are coming out, like Algorand, like Chia, so on and so forth, all of them use BLS. All of those have effectively aggregation, and so they effectively are able to work in the same way. So basically, there's two ways of seeing the world. MPC is very useful for Bitcoin right now. It's very useful for Ethereum right now. Bitcoin is adding Schnorr signatures. Once they had Schnorr signatures, basically you can do the same kind of mechanism using an on-chain Bitcoin component, and no one will use MPC for any of the future assets that are coming down because all of them have different cryptographic mechanisms that have effectively the signature ability of doing it on-chain.
Yeah. To an extent, right? Because like at the end of the day, with Bitcoin still BIP, but I agree with you that probably like we're using MPC as the term, but actually the right term is threshold signatures, which applies both to what we are doing with MPC and what you're referring to with BLS. And the future is actually threshold signatures regarding of the form.
Do stablecoins work the same way?
Stablecoins are Ethereum,
A majority of them are Ethereum.
So stablecoins you need to basically use, at the moment, MPC. If you don't want to use smart contract, which is basically...
Actually, an MPC panel would be pretty fun. With a whiteboard and...
we can sign everyone's degree afterwards.
Everybody will get a certificate.
All right, 2 minutes left. I want to give the next panel, it's regulatory focus, something to talk about. I know this is near and dear to many of your hearts. So if you had to point to one friction point in the regulatory space today as entrepreneurs, what would that be? Is it 15c3 issues? Is it the classification of tokens? Mike, we'll start with you.
I think it's at the end of the day, I think that it's that there is no clarity. At the end of the day, when you go and you talk actually with the big financial institutions, right? Like, you mentioned the Bank of New York Mellon and Goldman Sachs and some of the other guys, when you actually sit down in the room with those guys and you ask them, why are you guys, all of those guys have a decent amount of folks that are working on blockchain and crypto, but they are not really active in the market. And the reason why they are not is because there is reputational risk because of this ambiguity of what the regulator will say. And clearly, so we discussed, there are multiple regulators involved, and there is just not a clear guidance. That's it, in my point.
Just in general, or specific to custody?
It's specific to custody, but it's specific. It's one specific to custody, and it's like just general, like touching the asset class, like AML. AML is a huge issue for all of those guys because it's just like really unclear what you're supposed to. Let's assume like you're getting a Bitcoin transaction, you run it through chain analysis, and it says that it's 3 out of 10. What are you supposed to do? Is there like, is the regulator like defined? It's like, if it's free, I mean, at the end of the day, you have like UTXO, maybe like, 10 transactions or like 100 transactions before you receive the asset. Someone like use it on a gambling website.
Right. Chris?
I would agree the lack of clarity is the biggest challenge. It's a challenge for them. Regulators, by their nature, are not progressives, and our system in the United States is set up like that, right? We don't want the government doing things all the time, right? So we've designed it to move slowly, but it gets very frustrating when we don't have clarity. And so in our shop, all this AML stuff, we do a lot of that. We just try to be reasonable person as our guiding light so that we can justify it. But the lack of clarity continues to be a real challenge, particularly in the United States.
Yeah, we've been told not to speed, but haven't been told what the speed limit is, and that's it's really hampering innovation. Diogo, we're running out here, so we'll leave it to you for last words.
I think very concretely, the definition of QC, the fact that everybody's running around with trust companies, and basically you have the SEC effectively saying, hold on, that might not actually be the case. And so we're effectively in a limbo.
Yeah.
Awesome. Thank you very much for lending your expertise to the audience. This was an interesting
for having us.
Thank you.
Thank you. Nice job.
Thank you so much.
Thank you.
Great. Thank you.